Now, it's time for the market snapshot. Today, we are diving deep into market cycles. We'll understand what they are and how to navigate them successfully. Real estate cycles are prolonged periods of supply and demand imbalance. In fact, real estate markets are rarely near equilibrium, and understanding long-term cycles is the key to making smart investment decisions and deploying your hard-earned capital with a lot more confidence. There are four main phases of a real estate market cycle: recovery, expansion, hypersupply, and recession. These phases represent the periodic fluctuations in the real estate market cycle driven by economic conditions, interest rates, population growth, and most importantly, employment growth. Remember, these phases are specific to each real estate asset class and each submarket. We have all heard the famous phrase location, 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 which still holds true because real estate assets obviously cannot be physically moved. Therefore, local conditions play a significant part in assessing each real estate market cycle. Let's dive into each phase. Phase 1 is recovery. This is the phase of stabilization. During this phase, vacancy rates are at their highest and there's an oversupply in the market, which is either due to decrease in demand or excess construction. As demand starts to pick up, this oversupply gradually begins to decrease. In this phase, rent starts to stabilize, and this phase continues until the market reaches its long-term occupancy average and we inch towards a supply and demand equilibrium. Phase 2, we have the expansion phase. This is the phase of rent spikes. Demand growth here picks up and is stronger than the supply in the market. As vacancy rates fall and supply tightens, rents rise rapidly during this phase. Eventually, vacancy reaches a low enough level, leading to demand for new construction. As with most real estate phases, the expansionary phase can last a long time. The cycle peaks when demand and supply are growing at about the same rate, or when we put it in the economic terms, we are at equilibrium. Before equilibrium, demand is growing faster than supply, and after the point of equilibrium, supply grows faster than demand. The third phase is hypersupply, what I personally call the illusion phase. It's an illusion because strong occupancy hides the underlying shift happening in demand and supply, which is the beginning of oversupply in the market. In the hypersupply phase, the supply growth overtakes demand, and the vacancy rate starts to creep up as new supply enters the market. In this case, rental growth slows, and despite high occupancy rates, the market realizes it has turned downwards, eventually leading to a slowdown in new construction commitments. If the supply continues to grow faster than demand, the market falls into phase 4. Phase 4 is the recession. This phase begins as the market moves past its long-term occupancy average with high supply growth and low or negative demand growth in the market. Excess supply competes for much lower demand, leading to high vacancy rates and rapid rent declines. We can see that happening in most multifamily apartments across the nation. While the recession phase is challenging, it can also present opportunities for savvy investors. Savvy investors with a long-term perspective, the right capital stack, and the skills to identify undervalued assets can find enormous opportunities. The cycle usually hits bottom when new construction comes to a halt or when demand growth picks up and becomes higher than new supply. The fundamental truth is that if a real estate developer gets money, they will build. Similarly, if the debt is cheap and plentiful, real estate owners will overpay and will over-leverage. These two truths underscore the boom and bust of all real estate market cycles. Remember that bad real estate investment deals are everywhere, even in great market cycles. And you can always find good investment opportunities even in the bad markets. Drop us a comment to tell us what you are seeing in the market cycles in your local market. That's a wrap for today's market snapshot. The opinions and views expressed in this program may not necessarily reflect the institutional views of Tereos or its affiliates. The content of this program does not constitute a recommendation from Tereos to the recipient and is provided for information purposes only. Tereos is not providing any financial, economic, legal, investment, accounting, or tax advice through this program or to its recipient. You can find the complete disclosure at www.tereos.ai/podcast/disclaimer.